There's been a lot of talk about the fixed interest rate cliff, hasn't there? And it's suggested it could be one of the potentially biggest risks to our housing markets this year. In fact, it could destabilise our property markets and the banking system. Well, that's what some of the pessimists are saying, isn't it? With my guest today, independent financial advisor Stuart Wemyss, I plan to explain what the cliff is, some must-know pieces of information that put the cliff into context, and what you need to do if your fixed interest rate period or your interest-only term on your mortgage is about to expire. So welcome to today's show.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property and wealth advice. Now here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Mortgage rates fell dramatically during the pandemic. This was particularly the case for fixed-rate loans that were available for as low as even 1.95% back in May 2021, and that was for owner-occupiers. And that was partly because bank funding costs plunged in line with the Reserve Bank's temporary funding limit. The Reserve Bank tried to keep the wheels of industry greased over the pandemic. And at that time, banks financed around 1.2 million new home loans. That was between January 2020 and October 21. And that's based on the Australian Bureau of Statistics data. And that was when fixed rates were low and they kept falling. Fixed rate home loans historically comprised about 50% of all new loans. However, during that time, understandably, fixed term lending surged to about 46% of new mortgage commitments. That ended up in July, August 2021. Now, the Reserve Bank's October Financial Stability Review noted that about 35% of all outstanding home loans are on fixed terms. And this also included the fixed component of some of those people who got split loans where some's fixed and some's variable. And the Reserve Bank said that around two-thirds of the 35% outstanding fixed mortgages will expire this year in 2023. Hence, the cliff that people are talking about, that all these outstanding mortgage debts are going to be repriced over the course of this year. People are going to have to pay a lot more for their mortgages. When fixed terms come to an end, what are borrowers going to do? How worried should you be if your interest-only loan is coming to an end and you're going to have to refinance, or your fixed terms coming to an end? What should you be doing? That's what I want to talk about with my regular guest, independent financial advisor Stuart Wemyss, whose team at ProSolution Private Clients help clients all over Australia, not only with accounting and financial advice, but also with their mortgages. So he's involved in this every day. Hi, Stuart.
Hey, Michael. Great to be back with you.
Well, Stuart, I love getting your blogs every Wednesday, listening to your Investopoly podcast. And I remember after listening to that podcast, even though we speak quite a bit in between these chats, I specifically contacted you and said, mate, that was one of the best blogs you've written. Boy, you're going to help a lot of people. So I was very keen to have a chat to our audience here about what's ahead and what people can do. So what are your thoughts?
So obviously there's two things that happen during a mortgage, during a holder has a mortgage that can change and that people need to navigate. The first one is interest rates. So particularly if they've got an interest rate that's maturing, which you talked about in your introduction. And the second one is, and particularly for investors, is an interest-only term expiring. And sometimes these things can happen together. And if you've got a fixed rate that's set up as on interest-only repayments, then you have to then navigate potentially both of those changes all at the same time. And as you said in the introduction, what people are facing is this fixed rate cliff. It makes me giggle when I think about this.
Another cliff, Stuart, you're right.
I know. We had the interest-only cliff only a few years ago that was supposed to turn into Armageddon, and now apparently
the unemployment cliff. Remember, it was going to get to 11%. People love these cliffs.
Apparently, these commentators must think that most people don't read the news and for some reason must have thought 2% was going to be a forever interest rate, which I don't think anyone ever thought 2% was going to be their interest rate, long-term interest rate. But anyway, so how can people navigate this? Well, I mean, the first thing to point out is, as you said, Michael, at the beginning, that there's a lot of mortgages coming out of a fixed rate product. A bank will typically be more aggressive with fixed interest rate pricing for its mortgages than variable. And the reason for that is that they know their profitability models, they know how long they have you as a customer. And so they can be a little bit tighter in the margin, knowing that you're going to be there for 2 or 3 years. Whereas with a variable rate borrower, it's going to depend on statistics. And, if they're losing, if the average mortgage life is only 18 months, they're not going to be as aggressive. So the banks then are really worried about all these customers that have these fixed interest rates that are expiring because, firstly, they haven't made that much money out of them over the last couple of years, and they don't want to then lose that business. They want to retain as much as possible. And so the banks are super keen to price and offer discounts to retain business, to the extent now. It was only probably about 5 or 6 years ago, some lenders started offering cash incentives to refinance. And the whole rationale behind it was to offset some of the costs associated with refinancing and then provide a little bit of a financial incentive. That is now extended to some banks offering cash to stay with a particular lender. So borrowers are really in the driver's seat here. They really do have quite a lot of power in order to negotiate a better interest rate once their fixed rate has expired. The flip side to that, though, which I should say that most banks aren't going to pick up in a pricing discussion, is that you might be locked into your particular lender. So, of course, if we made a switch or applied for a loan a couple of years ago, it would have been tested at a much lower interest rate benchmark rate. So the banks add a 3% interest rate onto the current interest rate to calculate your borrowing capacity, essentially. So that was a very low rate. That's 5% 2 years ago. It's now could be 8-9% today. And so it's quite possible that you won't qualify for the loans that you currently have because interest rates have risen so much. Now, in that situation, you are locked into that lender if that's the case.
Let's make it clear. The bank's not going to kick you out of your home or make you sell up your investment properties. They don't want that. But this is APRA putting a borrowing buffer on top to protect our banks and make sure that lenders don't overextend themselves. And while that made sense when interest rates were low, correctly it did because interest rates have gone up 3%, some would argue that 3% buffer is excessive today, but only recently APRA came out and said they're not considering changing that at present. So what it does, as you said, Stuart, is it locks you in with your current lender, doesn't it?
That's exactly right. And eventually that buffer will most definitely be changed, but we just don't know when that will be. But we shouldn't take that as an indication that you don't have much negotiating power. Because ultimately, when you go and deal with the team that's going to price the loan, which is a retention team, they have no idea about borrowing capacity and credit policy and all those sorts of things. So to them, you're just an at-risk customer. So don't be perturbed by the fact that, I went and spoke, I'm with ANZ and I went to spoke to CBA, but CBA said no because I have too much debt as is. ANZ's not going to know about that.
This is one of the benefits of having a finance strategy on your side. Now, a lot of people call themselves mortgage brokers, but I'd suggest your team at Pro Solutions Private Clients are actually strategists because it's the holistic approach your team offers, understanding all the various bits that go together with finance. So even though if you've got a loan with a bank, having somebody like Pro Solutions on your side is helpful, isn't it?
I wrote a book a few years ago, Michael, you remember, called Rules of the Lending Game. And
yes, you did.
Rules of the Lending Game. I put game in there in the title because it really is a bit of, and you've said it yourself, property investing is a game of finance with a few properties thrown in or something. I don't know if I've made that a perfect clue.
Yes, no, that's right. I haven't used that expression for a long time, but of course it is.
Yeah, yes. So it is really a game and you've got to learn the rules of the game to be able to play it. And understanding, that the retention side of a bank is completely different to the credit side of the bank and you can then play that to your advantage. So, of course, as people are contemplating the end of their fixed rate, they're probably wondering, do I refix or do I remain variable? The problem today is, well, fixed rates are guided by what future bond rates are looking like, because obviously the bank needs to go and borrow that money and then on-lend it to you. Fixed rates will only become attractive when what's called the yield curve inverts, which means that longer term rates are lower than current interest rates, which it is to a small extent today, but not by a large enough margin. So therefore, the fixed rates that banks are currently offering or have the ability to offer because of the money market are just too high. There's no attraction whatsoever, to my mind, in fixed rates. Sometimes you would go into a fixed rate just for the interest rate protection, and you might pay a margin for that. But I would argue if we're at or close to the top of the interest rate cycle, what are you really protecting? Because your downside risk is in future interest rates is minimal. So I think for most people, probably 99.9% of them, the advice would be roll over to a variable interest rate, but take the advantage or make sure you take advantage of the fact that the mortgage market is super, super competitive at the moment to negotiate a much better deal.
Now, no one knows what's going to happen to interest rates, how many more interest rate rises there are going to be. That seems to keep changing month to month, or what's going to happen in the future. But it's interesting that a short while ago, Westpac suggested that while interest rates are going to rise a bit further this year, they suggested there's going to be 7 drops in interest rates. Now, again, each bank's got their own views on that. So I think later this year, interest rates will peak. Inflation probably has peaked, but that hasn't come through in all the statistics just yet. And when that happens, this is when the next stage of the cycle will move on. Consumer confidence, buyer confidence, seller confidence is going to return, even though we were speaking only a short while ago that it seems to have returned to our more mature clients who are getting into the markets now, and the next stage of the cycle is going to move on. It's not going to be the next boom, but it's going to be more the stabilization phase when buyers come back, sellers come back. So there's lots of things to consider with interest rates, and we're not making any suggestions here other than looking forward beforehand. So if you're saying that fixed terms coming up later this year, when would you suggest people start approaching their finance?
I think you've got to start the process 60 to 90 days before it matures, just to leave enough time. If you do need to refinance, you do need to switch to a new lender, leave enough time to allow you to do that. You might make that initial investigation and work out that you don't need to refinance. And if that's the case, then you really only need 30 or fewer days. Going back to your indication about Westpac, of course, they say that there's 2 types of economists out there, those that know they can't forecast and those that don't yet know that they can't forecast. But having said that, Bill Evans at Westpac, I think, has been right a lot more than most other economists. And so he's predicting the cash rate to be 2.35 by September 25. If his predictions are eventually reflected in the market, then I would expect fixed rates to start to become more attractive sometime next year in 2024. So it's like roll to variable now, but let's keep a watch on the market. And if the market gets overexcited by interest rate cuts, which it could, you might then start seeing some really attractive fixed rates, in which case then you can take it up. But for now, it's kind of switched to variable, I think.
One of the lessons I learned when my fixed rates expired back in the early 90s and I had to pay a lot more was never to lock in all my loans when I had substantial loans for the same term. So a lot of people, all their loans are going to expire this year. But if they had planned ahead, maybe some would have expired in 1 year or 2 years' time, others in 3 and others in 5-year terms. And that's just a protective mechanism. So we talked a little bit, Stuart, about what happens if you locked into a fixed rate loan and now it's expiring. What about interest-only expiries? In other words, for a lot of loans, you have an initial interest-only term, and then after a 3 or a 5 year period, you've got to start paying back principal.
Yeah, okay. So let's go back to the reason why we set up it as interest-only from the first place, and we can then ask ourselves whether those things are still correct today, as in your particular situation. So the 2 most common reasons we would set something up as interest only is firstly to minimize our commitments and cash flow. So to set the repayment amount at the minimum amount being just the interest, not making any principal repayments. And the most common reason we want to do that is that we want to direct cash flow elsewhere, whether that's repaying non-deductible debt, so that's your home loan, super contributions, other investments, whatever. The second reason is that instead of repaying the loan, what we would prefer to do is accumulate cash in offset account. And so by having an interest-only loan with an offset, we can still make notional principal repayments by just accumulating more and more money in the offset account, which obviously reduces our interest bill each month, but it still preserves the original tax-deductible nature of the loan. That way, if we want to use that cash for another purpose at any time down the track, we can do so. And secondly, it mitigates one of the biggest disadvantages about investing in property, which is illiquidity. So we know property's not very liquid. We can't sell pieces of it. And if we want to sell the whole thing, it takes many months and it's expensive. So one of the ways to mitigate that is instead of repaying the loan, just put a whole bunch of cash in the offset account. That way, if it's, you need it for a rainy day or something happens or you don't want to make other investments, you have the liquidity to be able to draw that cash out and reuse it again for another purpose. So if I'm facing the end of an interest-only period, I'm going to ask myself those two questions. Do I have better things to do with my cash flow other than repay the principal of this investment loan? And secondly, do I want to preserve the original tax nature of the loan and increase my liquidity for whatever, to either provide flexibility in the future or if I've got future plans that's going to accommodate? If you have a home loan, so non-deductible debt, the answer is almost certainly yes to the first question, in which case you should roll over to another interest-only term. The final complicating factor, and we sort of touched on this, was back in 2017, the government got a bit excited about how much interest-only debt there is out there. I think it got to about 40% of total new loans or something like that, and they wanted to reduce it. So one of the ways they discourage people from setting loans up as interest-only is increase the interest rate. And so the premium that you pay is about 0.25% higher if you're on interest-only. This is for investment loans. If you're on interest-only versus if you're on principal and interest. So if you don't care about the cash flow, you've got nothing else better to do with your money, and you don't care about the fact that you're reducing the tax deductible loan and you don't have that flexibility to redraw it in the future, and you want to save 0.25%, well then maybe switching over to principal interest is the best way to go. But I think for most people, it's really roll over the interest-only term. But I wanted to go through that sort of thought process and rationale just to make sure that people aren't just blindly going, oh, well, all investment loans are interest-only, so that's what I'm going to chase.
Well, I think this is valuable because if you go to the average bank, if you go into your bank manager or your lender, they're not going to discuss these matters with you. And to be blunt, if you go to the average mortgage broker, they're not going to look holistically like this as well. And that's why I really enjoy speaking with you, and I love seeing the results your team at Pro Solutions Private Clients can deliver to their clients, because you're looking at it strategically. Now, a lot of clients have got more than one property. They've got a large portfolio. What would you say they should be thinking about? How should they be going around this?
Yeah, there's a few considerations, Michael. Before I get there, just one final point, actually I forgot to mention with interest only, is really the mechanics of if you decide, how do I roll over? Can I roll over for another interest only term? So some people might not be aware, but most mortgages are structured over 30-year loan terms. And so if you have an interest-only loan, all it means is the loan term is split up. It's the first 5 years is interest only, and the remaining 25 years is principal and interest. And so actually when the bank calculates your borrowing capacity, they're calculating, can you afford to repay the remaining loan over 25 years? So if you go and ask for another interest-only term, what you're really doing is asking the bank to change how the term is structured. And so you're asking them to essentially change the original loan to 10 years interest only and 20 years principal and interest. And so again, the bank's got to be confident that you can repay the loan over 20 years, which is only a relatively short period of time. most banks, for that reason, most banks will typically allow you to have 2 interest-only terms, and that's it. After 2 interest rate terms, you've got to refinance the loan. You've got to reset the loan term again. The way to get a second interest-only term is different for each bank. Some of the larger banks now have actual teams that just deal with that. And so you put a call in, you give them a little bit of information, and they can process it over the phone. Other banks require you to complete a form. Other banks actually ask you to go through a full application to roll over an interest-only term. So you'll have to deal with your bank or mortgage broker in practically how you do roll it over. But suffice to say that if you've already had 2 interest-only terms, there's a really good chance you might actually have to refinance to a completely fresh and new lender in order to get a brand new 30-year loan term. And remember, it's a game of finance, so you just got to play the game. You can go red in the face arguing with the lender to say why they should give you another one, but if it's not in their policy, they just ain't going to do it.
Sure, but there are always other lenders out there, and they're hungry for business at the moment, Stuart.
Exactly right. So going back to your original question, Michael, what I tend to counsel clients to do is instead of looking at these decisions on a loan-by-loan basis, look at it holistically. And there's a bunch of things that we need to think about and ask ourselves when contemplating a lot of these decisions. So if we kind of zoom out a little bit and look at our overall portfolio and in fact our overall financial position, there's a few things I like to ask clients to get a better understanding so I can work out what do we do with these individual loans. And I'm not trying to make things more complicated than they need to be or invent problems or issues, but it really is just making sure that whatever I do today is going to help me to do whatever I need to do over the next 5, 10 years, whatever it might be. So I've got a list of things here, Michael, some of the considerations that I can just run through if you like.
Let's run through them, and I'm going to leave a link to your great blog in the show notes anyway. But what are the thought processes, please?
So firstly, you've got to think about borrowing capacity. Will that change in the future? And then that's mostly linked to sort of employment and income. And probably a real common one might be a job change or maternity leave, so starting a family. So if that's in the future, you might want to do the refinance today before that happens. Or if you're currently in that position, then maybe you've got to wait a little bit of time to do the refinance later. Your future borrowing expectations, another thing to consider. So that's like, are you going to invest in more property? Are you going to upgrade? Are you going to renovate? And if so, if you're going to do some of those things, should you be accessing equity now? And I'm sure you're the same, Michael, as an active investor, I'm always trying to maximize the amount of equity that I have. So I always regularly revalue and increase limits up to 80% of the value. Even if I have zero plans of using the money, I always like to have it just locked in place. You never know what's going to happen.
I learned that lesson the hard way in the early 90s when interest rates went up, when values of properties, and a lot of commercial properties in those days went down, and having buffers makes a big difference. So it buys you time because it's not going to be another COVID, but who knows what's around the corner. So I fully agree with you. And having those in offset accounts or redraw accounts or various facilities just buys you insurance, doesn't it?
Yeah, exactly right. And linked to that, in terms of considerations, you have to ask yourself, or your mortgage broker should be asking, does the lender still suit your circumstances? So there's no point trying to put a square peg in a round hole. Some lenders are very good with certain situations, other lenders are not. It's quite possible that because of your situational changes over the last couple of years, you may no longer suit that lender from a credit policy perspective, from a product perspective. So that's important to review. Also, how the lender is valuing your properties. If maximizing our borrowing capacity to increase our investment capacity is the goal, then property valuations have a big role to play in that. And it's possible, and we've seen it all the time, sometimes for whatever reason, a bank is just undervaluing a particular property. Whereas if we go to a completely different bank, we might end up with much higher valuations and, of course, then much higher equity, which puts a client in a much better position.
I guess this keeps reinforcing the fact that you shouldn't be going directly to the banks, but you should have a finance strategist like the team at Pro Solutions Private Clients. But there's a lot of good finance brokers out there in the world to protect you and level the playing field, because the bank's not going to tell you, if you're with the bank with the red logo, the bank with the yellow logo has got different circumstances, different ways of looking at you. So you need somebody who understands, and boy, there are so many options. I got no idea how you keep up with it, Stuart.
I know there are a lot of options. And I think if I look back over the last 20 odd years, I've refinanced probably every 3 to 5 years. I don't put that in my diary to say, okay, 3 years is up, let's refinance. It's just happened that way. And I think if you're an active investor and therefore an active borrower, it's unlikely that one particular lender is going to be the best lender for you 3, 4, 5 years from now. They might be, in which case it's fine. Don't refinance just for the sake of it. It's not that fun. But the reality is that these things change and they move around. Lenders become more aggressive, less aggressive. The credit policy is changing literally weekly. And so it's really important to, it's a much smoother process if you match the right client with the right lender, which is I talk about to the team here internally all the time. Whereas if you're going to try and marry up, and it's much like dating, if you try and marry up the wrong lender to the wrong client, it never gels. It's always going to be a problem, and you're never actually going to achieve the aims at the long run.
Unfortunately, some borrowers are lazy. There's so much work involved in the submissions now for loans that they think, it's just easier to stay where I am. But I take your point that it is definitely worth considering this and speaking with your broker about that. Now, there's one more point on your list here that you put about the things you've got to think about when you're considering this is, are you going to help your children in the future? Maybe wanting to give a family guarantee. And I read somewhere about how much the bank of mum and dad has grown to help. In fact, I'd like to do a future podcast with you about, is it easier to borrow today than it was when we first started off? So that'll be our next podcast together. And I guess we'll have a bit of a talk about the bank and mum and dad then.
Yeah, definitely. But, I think just general terms, thinking about what do my future borrowing requirements look like, as much as you can ascertain them today, of course. And one of those things, particularly for older clients that are more established, is that's some of the things they're starting to talk about. So we can then take it into account when providing that advice to say, let's go to CBA, for example, because not only do they tick all these boxes, but by the way, they're really good to deal with family guarantees, which they are, but just as an example.
Now, when I look at the monthly finance figures, it shows how many people are taking out new loans, but it also shows the refinancing figures. And refinancing has grown hugely over the last year. Is it that people are already getting ahead of the game and taking advantage of the opportunities now to change their loans to protect themselves from what could be ahead later on as their loan facilities expire? Yeah,
I think so. I mean, I made some broad comments to say the market's really competitive. Of course, that's not going to be the case in all situations. Some lenders might not come to the party, or in fact, the incentives, the financial incentives. I was talking to a client about this this week. The financial incentives are so substantial that actually makes it worthwhile going through a refinance. So I think the answer is, who cares? And you made the point just before, Michael, who cares who the lender is? I've got no loyalty to any particular lender. It's really, will the lender help me do what I need to do? And out of all the lenders that are going to help me what I need to do, who is the lowest overall cost? And really, let's talk about pricing, because at the end of the day, it is very competitive. It's very unlikely the difference is going to be price. It's not going to be interest rate or fees. The difference is going to be how easy is it? What's their borrowing capacity? Does their credit policy suit me? Are they going to help me do what I need to do? They're the main considerations. Price, not so much these days. It was maybe 15 years ago. There could be a big difference between lender A and lender B. Not today. It's too competitive. As a broad comment, it's too competitive. It really goes down to the non-financial considerations that help us shape a lender recommendation.
We started off talking about the fixed rate cliff, and I think it's probably worth finishing off on that while some are concerned about it, and there's no doubt that some people are going to get caught out this year. I don't see it being enough to crash the property market, Stuart, like some are suggesting. The Reserve Bank reported that under 70% of outstanding mortgages are on variable rates at the moment, just under. So still a lot of loans are variable, and even though variable rates are rising, we're close to the peak, so that's a different thing. But a lot of Aussies have got equity in their home. Sure, some have recently borrowed and overcommitted themselves, but I think because a lot of borrowers are with mortgage brokers, finance brokers, they're already looking proactively. And it's one of those things that if you know about a risk coming, it's nowhere near as much a risk as those things that come out of the blue for you.
And that's a sensational point. You know, that most of the commentary is like, it's going to be a surprise when someone comes out of a 2% fixed rate that their interest rate is now 5%. It's most certainly by now not a surprise. It's the only thing that's being talked about. And even the RBA made a comment in their recent board minutes to say Australians have gathered more savings in terms of cash offset, so forth, than perhaps, in their words, perhaps anywhere else in the world throughout that COVID period. So people aren't stupid. They know they've got a free kick. They know they've got a free kick through COVID. You know, that their expenses went down, including their interest rate. They had a lot more disposable income. They knew the party was going to end. Everyone knows the party's going to end. Doesn't mean they stop partying. Or they're reducing their partying now already, but you know, they know it's going to end. Now, I know if my mortgage rate expires in September that, okay, but I'll still enjoy it today while I can. And that's and of course, savings have increased. They're not spending all their surplus cash. So, you know, I'll go on record to say I think it is the biggest load of rubbish that I've heard in the last couple of years, this fixed interest rate cliff. But let's see what happens. Maybe we'll be doing another episode in 12 months from now and you can remind me how stupid I was. But my gut feeling is nothing, there won't be a blip on the radar. And the final comment will be, lenders aren't stupid. They're not in the business of selling houses. They're in the business of charging interest. If the lender, if Westpac is thinking interest rates are going to drop to, so the cash rate's going to drop to 2.35% in September 24, wouldn't they help their borrowers just through that little bit, that 12-month period where interest rates are unusually high? Of course they are. Of course they're going to do that, just like they did during COVID. So there's not going to be any false selling. There's not going to be huge. There'll be a small increase in arrears and maybe defaults, but nothing. It won't be a blip on the radar.
I agree with you, but the fact that it has been brought up and discussed a lot, I think has protected some potential people at risk. And the other side, as I said a moment ago, is that a lot of people have got a smart mortgage broker on their side who looks after them. Most brokers actually review their clients once a year, and they're already prepared for that. So, Stuart, there are things you can do.
Actually, in fact, I'll say, because we had a group meeting yesterday, the person that looks after all our mortgage broking area said we haven't received one call from one client or email worried about higher interest rates. Not one call. There should be one client that's worried about. We haven't received one call. I think that's a pretty good sign that we're probably not going to head into any sort of fixed interest rate cliff.
And we're starting off in a good position with good equity in homes, still good savings, even though we're eating away at our cash stash that people stashed away over COVID. People have got jobs and higher wages, and they're going to be able to pay for their mortgages. Investors are getting higher rents. That won't totally cover the higher cost of interest, but goes some way towards this. And the mortgage default levels are very, very low at the moment, aren't they?
They've been stubbornly low for 20 or 30 years, Michael. So we've been through a GFC, we've been through a cash rate in the 7.55, I think, in 2008. We've been through the GFC, the credit crunch, which was more substantial than really anything else that's happened. Interest-only cliff. We navigated through that cliff. It ended up being a very shallow cliff. I'm sure fixed rate as well. So that's the thing about, Australia. Economically, we're very sound. Unemployment's still very low. I mean, the labour market's weakening a little bit, as you should expect, but still extremely low unemployment. All the signs are great, but it just doesn't sell papers, of course.
Of course. And of course, the other thing is that around 70% of homes are owned by owner-occupiers who are not speculating. Half of them don't have a mortgage. Of the other half, a lot have paid off their mortgage over the last 10, 15, 20 years. And those who are going to be in some distress, rather than selling up, they'll eat Maggi noodles for a while, Stuart.
Exactly right. Yeah.
Now, Stuart, I'm going to leave a link in the show notes to the original blog, which gives even more detail, to your Investopoly podcast. And we've spoken a couple of times about Pro Solutions that offer a holistic approach to clients, not just finance, but accounting and financial planning. So there's a number of ways people can get in contact with you. And I look forward to catching up with you again real soon.
Fantastic. It's been fun. Thanks, Michael.
I hope you enjoyed my chat with Stuart, and in a moment I'm going to share with you my mindset message, but I hope you understood from our chat that we can see some headwinds ahead for our property markets, but we're both very comfortable with the long-term fundamentals, and then our property markets are going to do well. So while they will create significant wealth for many Australians, statistics show that 50% of those people who buy an investment property sell up in the first 5 years. And I can't see that being different moving ahead, where our markets are going to be very fragmented and the market's just not going to work like it did a couple of years ago where all properties go up. But it's also over the years been shown that of those who stay in the investment game, 92% never get past their first or second investment property. So I guess the point I'm trying to make is that while property is a way to wealth for some Australians, attaining wealth doesn't just happen. It's got to be part of a well-executed plan, which in my mind is bringing your future into the present so you can do something about it now. But buying a property isn't a plan, isn't a strategy. You've got to start with the end game in mind, understand what you need, what you want to achieve, and then build a plan, a strategy to get there. And at Metropole, we have got frameworks that help our clients outperform their averages. Our clients are more likely to be in that top 1% of investors than average Australians, in fact 7.3 times more likely due to a recent audit, because we help them plan, and the property they eventually buy is the physical manifestation of a whole lot of decisions they've made, and we've helped them make in the right order, because property investment's a process, not an event. So whether you're a beginner looking for a time-tested strategy to make sure that you don't make the mistakes others make, or if you're an established investor, maybe you're stuck, maybe you want a second opinion, an objective opinion, or maybe you just want to get to the next level, I suggest you allow my team at Metropole to help build you a personalised, customised strategic plan. Of course we want you to buy properties. By the way, we don't sell properties. Of course we want you to build a portfolio, but we suggest you start with a plan. So go to metropole.com.au, and when we help you plan, you're going to define your goals. You're going to see whether they're even realistic, because for some people, the right answer is not to do anything just yet. If you're already an investor, we'll measure your progress towards your goals and see whether you're heading in the right direction. We'll find the way to maximise your wealth creation through property, but just as importantly, we'll help you identify risks. Some of them you hadn't even thought of. Go to metropole.com.au. I'd love to be part of your ongoing wealth creation journey.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's Mindset Moment, I want to share with you the money habits that separate the rich from the poor. And in my studies, I found that most adults start with the same amount of money. They just have a different philosophy. Now, sure, some people inherit money, but most of today's millionaires are self-made. So, as I said, most of us start with the same amount of money. But here's the exciting thought. Why not work full-time in your job and part-time on your fortune? See, most people want to get involved in property investment and do it full-time. Doesn't work that way. Definitely not at the beginning. So I'm suggesting you work full-time on your job and have a part-time job working on building your wealth. And what a feeling you're going to have when you can honestly say, I'm working on becoming wealthy. I'm not just working to pay my bills. When you have a wealth plan, when you have a strategy to get to where you want to go, you're going to be so motivated, you're going to have a hard time going to bed at night because you're going to be so excited that you're working to build wealth for your long-term future, for your financial independence. So indulge me for a moment, because I'd like to share with you a simple formula for creating wealth. here's my thoughts on how the money that you earn should be allocated. And it's what I've learned from one of my mentors, Jim Rowan, who taught me the 70-30 rule, that after you pay your fair share of taxes, you've got to learn to live on 70% of your after-tax income. So they're the necessities in life that you've got to spend money on. But then it's really, really important to look at how you allocate that remaining 30%. And I'm going to propose you allocate it in the following way. I think 30% of the 30%, about 10% of your income, should go to charity. In my mind, charity is a way of giving back to the community and helping those who need assistance. I believe contributing about 10% of your after-tax income is a good amount to strive for. Now, I believe it's also something you've got to learn early because it's easy to do when the amounts are small. It's pretty easy to give $10 when you've got $100. It's considerably harder to give $100,000 when you earn $1 million. Oh, you're probably thinking, if I had $1 million, I'd have no trouble giving away $100,000 to charity. I'm not so sure. $100,000 seems like a lot of money. But if you start early to develop the habit before the big money comes your way, you're very likely to continue it on later in life. That's one of the things wealthy people do that the average person doesn't see they do, and they think wealthy people are greedy and don't look after the community. Many of them do. Now, with the balance of that 30%, in other words, 20% of your income, I think you should be allocating it to savings and investing. It's one of the most exciting parts of your wealth plan because it's going to give you peace of mind knowing that you're preparing for the winters of your life. So that's one of the big differences between the rich and the poor. Poor people spend their money and save what's left, while rich people save their money and spend what's left. If you think about it, go back, 20 years, and two people earn the same amount of money every month, and they've earned the same pay increases over the years. But if one of them had the philosophy of spending all the money and saving what's left, and the other had the philosophy of saving first and investing that money and spending what's left, imagine the difference between those two people today. Today, if you knew both of those, you'd call one poor and you'd call the other wealthy, wouldn't you? So remember, spend 70% of what you earn on your day-to-day living, what you keep after tax on your day-to-day living, 10% to charity, and the balance you save. And when you've got sufficient savings, then you start investing it in growth assets so that over time you're then going to use the magic of compounding and leverage and time. Day by day, week by week, the results are hardly noticeable. But in 5 years' time, the differences are going to be pronounced. And at the end of 10 years, the difference is going to be dramatic. So, as I said, the rich and the poor all start with the same amount of money. They just have a different philosophy. Well, thanks for spending the last little while with me, and I hope you got some benefit from this show. If you did, and you know somebody else who'd also benefit, please tell them about the Michael Yardney podcast. There's a share button on every podcast app. On Apple Podcasts, there's 3 little buttons down the bottom. Press it and share it, or just tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour, and you'll definitely be doing me a favour and helping me in my quest to make as many people as possible financially literate. Now, there's ways of catching up with me between these shows. Just look for Michael Yardney on social media, or why not join my private Facebook group? Go to Facebook and look for the Property Update Facebook group. And I have a way of saying thank you to you for subscribing to this podcast. Go to podcastbonus.com.au. There'll be a link in the show notes, podcastbonus.com.au, where you can get a bunch of ebooks and reports. My way of saying thank you. And when you've got time, why not listen to some of the old podcasts? There's individual lessons in each of those that I think would be helpful for you. I'll be back again real soon. In the meantime, have a great week. Make it a great week.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success, and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?